In this week's video, we'll see how top chess players, fighter pilots, and football coaches leverage time-tested principles that can also be used to manage risk and reward in the financial markets. We'll kick off the video by reviewing the objectives of the new screens that we added to the CCM market model in May of 2017. We'll look at full year performance, review some what-if scenarios, and review the backtest of the CCM master model with the new screens from a long-term perspective. In order to properly evaluate the CCM market model's performance in 2017, it is helpful to review a video clip from May 19th, which described the objectives of the new front-end screens. So let's go to the videotape. In the slides that follow, we'll be covering some powerful concepts that will help us navigate between point A and point B, reduce trading frequency between point A and point B, and enhance returns between point A and point B. Now we're back in the present day, or January of 2018, to recap the objectives of making the simple and powerful adjustment that we made in May of this year was to help us navigate between a point A and a point B. We wanted to try to reduce trading frequency between point A and point B, enhance returns, and we also noted in May of 2017 that the simple adjustments and the chess moves that we made at that time had nothing to do with the master model, and they had nothing to do with the master model giving us bearish signals at that time. Therefore, we can use these objectives as a measuring stick to see how we did between May of 2017 and the present day. One of the major positions that we added to the portfolio as a result of the new screens in May of 2017 was the Vanguard Information Technology ETF, or VGT. We entered that trade in mid to late May, and we still hold the position today. And thus far, we're happy to report the performance of the new screens has been excellent. The number of trades between point A and point B, 0. We bought the position, held it here, classified this as volatility to ignore, and still hold the position today. So the new screens did help us navigate between point A and point B. They did help us reduce trading frequency. We haven't made any trades, and the returns thus far have been promising since entering the trade in mid to late May. We're now up over 20% as of January 4th, 2018. To provide another example, one of the other major positions that we added to the portfolio as a result of the simple and powerful adjustment in May of last year, or the new screens, was the Vanguard Growth ETF. How did we do managing against these objectives that we outlined in May of last year? Said we wanted to navigate between point A and point B. We bought the position, classified all of this as volatility to ignore, and still hold the position today. Trading frequency, excellent. We've made no trades so far, and the returns are favorable with a gain of almost 16% as of January 4th, 2018. As we outlined in detail in the May 19th, 2017 video, we had somewhat of an aha moment in May of last year, and thus we implemented the new screens. So from a performance perspective, in 2017, we had something that we were concerned about from 12/31/2016 until May 19th, 2017. And thus far, as we've shown with the hard data, we appear to have addressed that concern. Therefore, if we take a look at full year performance, including the period without the new screens and the period with the new screens, the vast majority of clients will fall in this range here. These are full year client returns for clients that were with us for the entire calendar year, net after all fees. Since we all do similar things based on the model, you might ask, why the variance? Clients have specified their tolerance for risk, which varies from household to household. Some households have one account, some households have 5 accounts. The dollar size of the accounts can also affect position size and trading costs. Distributions taken during the year impact performance. Deposits as well when we have cash coming in or a large incoming transfer from another firm. Later in the video, we'll examine the question, what would those performance numbers look like if these screens had been in place for the entire calendar year? And it's important to note these numbers here include a migration and exit strategy for bear markets. You may also remember back in that May 19th video, we said that our core positions or the master market model was working fine. At that time, our positions were up between 9 and 14%. How did these positions do for the full year 2017? And ultimately, positions like SPY and VOO are managed by the master market model because the master market model is based on the S&P 500 or SPY. So how did the master market model do managing those positions for the full year? And how does the model's performance stack up against these simple objectives? We entered the year owning SPY. So how many trades did the model make between point A and point B, which is year end? The answer is 0. And we were able to capture a satisfying gain. We should also keep in mind, if I'm a buy and hold passive investor in SPY, unlike these return numbers here in these client accounts, a passive low-cost buy and hold investor has no exit strategy for a bear market or crisis. The news is also good. Full year for VTI. We owned VTI coming into the calendar year. The model did an excellent job managing the position with 0 trades between point A and point B, allowing us to capture a very satisfying return and check these boxes over here. Our trading frequency and performance for VTI and SPY tell us that the master market model basically performed as expected and performed very well in calendar year 2017. Our known issue was the ETF screens, and the numbers that we've just reviewed say that so far it looks like we have addressed that concern. One of the main things that the CCM market model does for us is it helps us determine a prudent allocation between growth-oriented assets, such as SPY and VTI, and conservative assets, such as bonds, cash, or currencies. Now, with the benefit of hindsight, we know that calendar year 2017 was very, very favorable for stocks. Therefore, we can also grade the CCM market model's performance in 2017 by looking at the model's allocation to stocks, and more importantly, our actual allocation in client accounts over the full year. Fortunately, the news is also favorable there. As these numbers indicate, there was nothing wrong with the master model in May of this year, and there's nothing wrong with the master model as of year-end 2017. The average client exposure based on all client accounts that were here for the full year was 98.4%. The median full year exposure to stocks was 99.3%. The model correctly did not allocate to cash in any meaningful way or to bonds, and it didn't even remotely consider using an inverse ETF in calendar year 2017. And it may be easy to forget, now that 2017 is in the books, that the model's bullish stance following the U.S. election and our bullish stance early in calendar year 2017, and the fact that we allocated to stocks the entire calendar year, that was a contrarian position relative to Wall Street strategists. February 21st, 2017, Bloomberg. Analysts forecast a 5.2% gain in the S&P 500 in calendar year 2017. They were way, way off. March 2nd, 2017, Wall Street Journal. Skeptical Wall Street strategists undone by market rally. This was our allocation for the full year. Wall Street Journal, September 12, 2017. Skeptical investors fail to derail stock rally. And as we approached year end, the Wall Street Journal took a look back at the professional forecasts that were made before 2017 kicked off, and their conclusion: Wall Street's 2017 market predictions pathetically wrong. Therefore, we feel fortunate that the model carried a very, very heavy allocation to equities in a year where it was favorable to do so. Just to make sure we're comparing apples to apples, especially if you're not a current client. These are dated articles. Let's compare them to dated material for CCM. So let's compare this pessimistic outlook to CCM's stance throughout 2017. We already know this number here, but if you're not a client, you can't see that. But you can see this. You can Google this title here along with my last name, and you should be able to find a January 4th, 2018 article on Seeking Alpha. In that article, there are links to 29 articles that were posted, dated articles, in the last 13 months. The conclusion of all of the 29 articles, based on the facts that we had in hand, bullish, which is quite a bit different than the professional Wall Street stance during 2017. And if you're looking for more hard evidence to contrast the pathetically wrong predictions, you can review this video here. You can find it by Googling Leveraging 2017 Charts to Improve 2018 Odds. It's a compilation of commentary and video clips, dated video clips, that we posted over the past 13 months. Since we plan on using these new screens going forward, it's incredibly important that we can answer this question. How would the screens have impacted returns if they were in place on 12/31/2016? And more importantly, how can we expect the new screens to perform in conjunction with the market model in a wide variety of market scenarios: bullish, bearish, and indecisive? We won't spend a lot of time on the backtesting results, but we will tell you where you can find them. We're in the process of migrating to a new website. You can find the new website at ccmmarketmodel.com. And since we'll be using these new screens going forward, these are the performance figures that are important to us from an expectation and management perspective. You can find them on the market model page on the new website. If we scroll down, we can answer the question, what's a reasonable expectation for our returns if those front-end screens were in place for the entire calendar year? The answer is 25.66%, which is reasonable and logical because the model is allowed to overweight technology. And if we overweighted technology for the full year, we would have been able to outperform buy and hold SPY. One of the reasons why the New England Patriots have been so successful in the National Football League is that their attention to detail from a game planning perspective is second to none. The key points from this quote here from Mass Live: between the identification of scheme and detail, each play could take as long as 20 minutes to diagram in full. Each game had 50 to 70 plays on each side of the ball, meaning offense and defense. Each coaching assistant had 3 breakdowns per week. As technology has advanced, the pads have been replaced, meaning they used to do this by hand, but the fundamental demands of the position, the radical levels of detail, have not changed. In this job, Josh McDaniels said, who is now the offensive coordinator for the Patriots, you learn the most important, valuable lesson that you keep to this day. Everything is important. There's a lot of similarities here to the backtesting project that Kathy and I just worked on for months. We went to radical levels of detail, and it took a very, very long time to complete. To give you some idea of the radical level of detail, the answer to this question, how many data points were included in the front-end screen backtest? The answer, over 240,000. Most of them are represented by zeros and ones that have been manually entered after reviewing charts. None of those answers are particularly complex when viewed in isolation. However, it's nearly impossible for a human being to process that much information. This is an area where computers excel and can assist humans in the decision-making process. I also want to mention at this point, I have to thank Kathy Shavako for her countless hours of very, very detailed work on this backtesting project, and her error rate is unbelievable. Any project that she works on is extremely accurate, which is extremely important in this business. Even if you manage your own money and you never, ever intend to hire a third-party money manager, it is extremely important to water test your portfolio. Take a look at it and see how would this allocation have performed in bear markets. Most passive buy and hold investors are probably not aware of the magnitude of the losses that can accrue during a normal and 100% to be expected bear market. It's not a question of if we're going to have another bear market, it's simply when. So you have to ask yourself, do you have a bear market game plan? For the most part, we know exactly how we will handle any market situation because all of them are a permutation or combination of three basic structures: bullish trends, sideways consolidation, and bearish trends. And since the model makes adjustments in line with the rate of deterioration or rate of improvement in the hard evidence, it can handle difficult situations and be adjusted to difficult situations as well. That doesn't mean difficult situations will be easy, but as we've noted in 1987 type videos, we do have a way to handle those very, very difficult situations. So what would have happened if you were a passive, buy and hold, low cost, I don't want to trade and I never want to have any tax consequences investor in blue chip stocks in 1929? The answer is, between the peak in 1929 and the bottom in 1932, you would have seen 89% of your capital destroyed. Can you imagine if you worked for 30 or 40 years and accrued a nice nest egg, and then in a very, very short period of time, you lost 90% of it? Can you imagine the emotional damage if you had $1 million, lost 89%, and you woke up one day and your $1 million was worth $110,000? Your $5 million was worth $550,000. Your $10 million dropped all the way to $1.1 million. That's a lot of money, but if you have $10 million, you may not be able to cover your expenses with $1.1 million in retirement. And if you've accrued $500,000 and you followed the passive buy and hold under all circumstances and keep your expenses low, your $500,000 would have dropped to $55,000. This isn't some hypothetical scenario. This is a real-world example of something that happened in the financial markets. And early in my career, this was treated as, this will never happen again. I started working on Wall Street in 1994. Well, that's not really true. After that point, after we heard this will never happen again, The S&P 500 lost over 50% of its value in the dot-com bear market, and then just a few years later in the financial crisis, stocks lost over 50% of their value. Which begs the question, do you have a bear market game plan? A fair question might be, why do you use so many inputs and a weight of the evidence approach? We've done a ton of back testing. We've tested all inputs in isolation, and we know sometimes the 78-day moving average might look good in some scenarios, and in the exact same scenarios, the 79-day moving average might produce terrible returns. Let's look at an anecdotal example, an admittedly oversimplified example. But let's assume that my game plan was basically I'm all in when the S&P 500 closes above the 50-day moving average, and I'm all out when it closes below. We could tell the same story with the 100-day, the 150, the 200, the 300. The concepts are all the same. Sometimes a single input under some scenarios works very, very well. But the reason why we diversify the same exact input and strategy that can work very, very well, if we haven't back tested it, we may have no idea that this could turn into whipsaw city. If we're using a weight of the evidence approach with multiple inputs, it doesn't mean this type of scenario is going to be easy. But if I'm using one input and that input isn't working particularly well, and that happens from time to time with all inputs, this is going to be a very painful whipsaw process. We can't eliminate whipsaws in models, but we can minimize the probability of whipsaws by using multiple inputs. And more importantly, using multiple time frames, very long time frames, 50-month moving averages, and shorter time frames all the way down to daily charts. When we study historical charts and perform back tests that have excruciating detail, it's very, very similar to breaking down film in football. The zeros and ones are a lot like diagramming where players move on the field. Think about how many zeros and ones it would take to program a video game to simulate these movements. It doesn't mean any one of the zero or ones to program those movements or to diagram the play is particularly difficult in isolation. To get down to the level of detail that you need, it takes a long, long time. If we look at the Air Force's Top Gun program, it also serves as an excellent analogy to very, very thorough and detailed backtesting. The Top Gun program provided pilots with the opportunity to try different things and make mistakes without fatal consequences, like an 89% loss, to get feedback and figure out how to do it better, and then put their lessons to the test the next day. And they can do it over and over and over again. We can do the exact same thing once we've done all the terrible, laborious work to build those spreadsheets and to punch in all the zeros and ones. We can get feedback and figure out what works, what doesn't work, and in the end, build a more robust model. Let's assume the answer to this question is no, you're not a client. Let's put this 89% loss in some historical context. From Jesse Livermore, someone who studied markets with excruciating detail. There is nothing new on Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. And will happen again. Even in markets that feature the strongest of strong trends, and clients and regular viewers of these videos know that we have a very positive outlook from a long-term perspective based on the facts that we have in hand. But during calendar year 2017 and during any advance that might take place over the next 5 to 20 years, we still have peace of mind when we put our head on the pillow at night that we can answer this question with the affirmative. The more you study success literature, the more you realize that the traits of top performers are very, very similar across a wide range of industries, professions, and tasks. From Peak, this is a book, Secrets from the New Science of Expertise. Anyone who is serious about developing skills on a chessboard would do it mainly by spending countless hours studying games played by masters. Research has shown that the amount of time spent in this sort of analysis, not the amount of time spent playing chess with others, is the single most important predictor of a chess player's ability. These years of practice make it possible for chess players to recognize patterns of chess pieces, not just their positions, but the interactions among them at a glance. We're not going to get really, really good at trading or managing risk or investing by solely trading, managing risk, or investing. The way we get really, really good is by studying markets, historical charts, which allows us to recognize patterns and the interactions between multiple markets, asset class behavior, indicators, and moving averages. This concept here gave us the confidence after the U.S. election to implement properly based on the model's output. As we covered in numerous videos in late 2016, early 2017, the setups were there. Because if it's happened before, it will happen again. Because years of practice makes it possible to recognize patterns. Because having tools to run if-then scenarios with a spreadsheet allow us to get feedback and figure out how to do it better. The concept of pattern recognition and the thought that there's nothing new under the sun is why on June 30th we're putting out quotes like this when we see chart patterns like this and quotes like this. Since there's nothing new under the sun, at some point we'll have a chart pattern like this in the future. Instead of getting a bullish breakout, we will get a bearish breakdown. And we most likely will also be tweeting quotes, but the quotes will basically be saying it's time to seek shelter. As we've noted in these videos for quite some time, and this is the June 30th video here, based on the information that we have in hand as of early January 2018, the very long-term outlook for stocks remains favorable. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. Here's one example of an FAQ you can find on the new site. What would happen to my online smart allocation in a bear market? Like the NFL coaches that diagram plays, or the pilots that go to Top Gun training school, or chess masters who take the time to study setups and boards for hours and hours and hours. We always learn something when we perform backtesting, when we prepare for these videos, and when we study historical charts. Regardless of what the charts look like today in early January 2018 from a long-term perspective, it's incredibly important that we continue to wake up every day with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.